Hi, this is Drew Tignanelli, and this is our March update. Thomas, the markets are kind of quiet this year. They were down a little in January. They popped back up in February.
Yeah. Well, and you hear every day that the markets are hitting new highs. We're seeing the Nasdaq almost getting back to where it was 15 years ago.
Right. 15 years ago, So, but the overseas markets have been stronger, especially Europe.
Mm-hmm.
But when you factor in the currency devaluation of the euro, it almost takes away the whole gain that the euros had this year.
Yeah,
or that the eurozone countries have had this year.
Yeah, and the strong dollar was a big impact last year.
Yeah.
10 to 15% in general on the euro profits and the investments internationally for a U.S. investor. And then what we're seeing now, as the companies have been reporting so far here in early 15, a lot of our U.S. companies, the multinationals, have been dramatically impacted in a negative fashion due to the international exposure that they've had when they've had to convert that to the U.S. dollar.
Yeah, matter of fact, our film producer here was telling us how he was getting hurt with that exact thing. The conversion rate, he does a deal in another currency, he thinks that's a great deal, and then by the time he gets paid and the currency devalues, It's like, hey, I didn't make as much money. So big corporations experience that all the time, and they try to hedge it, but there's just no way you can hedge it perfectly.
Right.
But anyway, the bond market has also been extremely volatile. We popped all the way down to 160, I think, on the long bond, 10-year bond, and we got all the way back up to 225, I think, on the 10-year. Now we're all the way back down to 198. That's that doesn't sound like a lot, but that's a huge movement in interest rates. That's the tug of war going on between, is there inflation going to come? Is the economy going to recover and we're going to have inflation? Or are we going into this abyss of deflation?
Right.
And so...
Yeah, and what's the Fed going to do with short rates? And then what's the impact on the rest of the market, mortgage rates and the like? And like you said, the 10-year, every 1/4% that it moves, that's going to be a 2 or 3% move in the returns in the bond market.
A lot of people don't understand that when these interest rates move like that, when they go down, clients are making money on appreciation in the bonds. And when they go up, even though they're getting that interest income, the principal could drop down, that you're actually, if you tried to sell your bond, you would get less money than what you would have gotten if you wait until it matures. Could be 10, 15 years down the road.
Right. Yeah, the concept of mark to market. So when people get their statements, they're like, well, how did I lose money in bonds? Well, if rates went up, your value went down, at least for that period of time. If you have an individual bonds, you can hold them to maturity, you'll get your money back, but then there's an opportunity cost that's been missed there, perhaps.
But all in all, it's been a quiet market this year.
Yeah.
I don't see anything disastrous on the horizon, and I don't see anything to go, wow, this is the great. You've had over 5 years of an up move. The longest running historic up move is 60 months. So we've already surpassed that. And we're headed into uncharted territory.
Right. Yeah. And part of that is remembering what we came out of.
Yeah.
We were so low, and so we're just hitting new highs now, even though we've been into this thing for over 5 years.
Well, anyway, as I say, and I think that there's not a lot that we can really, deal with in the sense of the investments. We wanted to go on to talk about some of the tax issues. Like, for example, a lot of clients are concerned that I haven't gotten my brokerage, tax information.
Right.
And they want to get their returns filed immediately and so forth. And I understand and I appreciate that. Somebody who does tax returns, you appreciate those early birds, because then you don't get them all coming in the last month. But, the brokerage firms have been wise this year to wait as long as possible. They've asked the IRS for extensions. Some companies, I've heard Wells Fargo and Raymond James actually, I believe, are saying they want to wait until March 15th to get their brokerage tax information out. And the IRS has granted them the extension. So the question is, that clients are asking, why is it taking so long? Don't they have to get it by the end of January? And the answer is no. They can have these extensions, and it's a good thing that they get the extension, because I think many of our clients have experienced where they get a correction. So they get their statement in the beginning of February, and then at the end of February they get a correction, and in the middle of March they get another correction. Right. And if you filed your return and you're getting these corrections are 90-some% of the time in the favor of the client to reduce their tax burden. Mm-hmm. But it could be only $10, $15, or $20 that you're reducing. And if you file your taxes and then you got to fix it to save $10, $15, or $20, it might not be cost effective to do it. And it's best to just wait. Be patient, get the return in, get the information in, get your return ready, but don't actually file until late March. That's what I always tell people. Wait, if you're getting a brokerage statement, wait until late March to file the actual return, because that way you're assured that there's no possibility you're going to get a correction by then.
Yeah, there's no sense in going through that whole revision process and having to refile or send an amended return, because if your numbers don't agree with what the brokerage firm is sent to the IRS,
yeah, you're going to get a letter.
That is the red flag. If people are worried about red flags, that is one where you can actually get a red flag.
You're going to be sure to get a letter from the IRS if you report numbers on your tax return that are different from the final corrected 1099 that ultimately gets filed with them. So it's important that get filed properly. Mm-hmm. But the other thing we wanted to talk about is, our long-term relationship with clients is called personal financial management or personal financial supervision. Mm-hmm. Management is where we're making the investment decisions. Supervision is where a client has told us, this is what I want to hold. There's a difference in fees and so forth, but the service, the comprehensive advice is all the same, where we help with any area of personal finance. Mm-hmm. And the one that we were talking about is retirement, because there's a lot of companies, and even the state are offering these, hey, get out early, and we'll give you some money to leave. Right. And we've had a couple people that have called us and said, should I do this? Right. Is this a good deal for me or not? And and it is all a present value calculation, but also the other side of the coin is it's psychological. Mm-hmm. Are you longing to get out? Right. And if you are, and it's killing you to stay working, then we have to figure out some way to get you to retire and so forth. But if you're enjoying what you're doing and you enjoy the people you're doing it with, retiring early is it's never going to be an economic decision. Right. It's because economically, every day you work longer and make more money, you're obviously going to be better off economically. I've heard people say to me, well, if I continue to work, I'm going to basically be working for nothing. Yeah, there are some really unique situations where I've seen that you could possibly make that argument, but in reality, it's almost impossible that if you continue to make a good salary, that continuing to work would not be economically advantageous. And so, really, you have to make that decision based on the economics of the number, but also, what are we going to do? Psychologically, do you have to get out? And what are you going to do when you get out? That's also another very important point. And that's what we do. That's what our long-term relationship's all about.
That's right. And people should call us to talk about these issues, because it's not just about the numbers. There are other elements to it in terms of the emotional side and the like. And many times these companies are offering it to the entire employee base that's over a certain age. So it's not that they necessarily want everybody to take the package, but there's something wrong with them. So it's okay to decline some of these packages. Absolutely. You don't always have to take it. Now, there are cases where you're given a package. In either case, come to us. Let's walk through the scenarios with you to make sure you know what you're getting into and what you're signing up for. And but it is very common, like you said, the state of Maryland. We had a local employer in Hunt Valley here. We've just gone through that with a lot of their employees, helping them think through that process. And we need to want to make sure people know that that's what we're here for, because our services are built upon that foundation of comprehensive, ongoing financial planning, anything that affects your finances.
And we're fee only, so we do it without the economic bias. And that's why local employers like Johns Hopkins University hires us to come in and teach retirement seminars to their employees. And that's actually, they just hired us also to come in and teach their graduate students to help them learn about the kickstart of their life, you know?
Right.
And so we're actually coming in at both ends with that institution. So anyway, it's what personal financial management and supervision are all about. This is Drew Tignanelli saying God bless.